Welcome to the 44th episode of the Advisor Tech Book Live podcast. My guests today are Io and Alex of Bridge, and we'll be talking about private investing or private investments. One of the two. Welcome, guys.
Thanks, Joe.
Yeah, thanks for having us.
So first, maybe just like a brief overview of the private investments and alts marketplace as it stands today in March 2026.
Yeah. So I think the way that we look at this market is you sort of have four quadrants as we see it. So you have GPs and LPs really being, very simply the two sides of the ecosystem. And then you have activities that occur pre-transaction and post-transaction, right? And so you have GPs actually deploying the capital that's been committed by LPs, and you have the whole process of how those LPs find those GPs and evaluate them, ultimately subscribe into their fund products, and enable those GPs to go and do the work that they've been effectively hired to do, right? And then on the post-transaction side, you have sort of everything that happens downstream, having made those commitments and investments to manage and maintain that private portfolio, right? And I think when you think about that four quadrant, where Bridge lives is on the post-transaction LP facing side of the market, at least today, right? But that's at a high level how we think about the mix.
Great. Yeah, and then how did you guys get into this space? And then maybe a little about how you guys met.
Sure. Yeah, happy to start with how we met. So I grew up in the Boston area, started my career after graduating college at Citigroup. So I moved to New York to work as a banker there for a few years, then to Blackstone, where I was an investor on their GP stakes team. In that seat, you see a ton of fund reports and data, and that's where the wheels started turning in my head, seeing how messy all the information was, how scattered it was across different portals and other. And so finishing up my time there, while also hearing something interesting from like management, which was, there's a trend here where our products, the B REITs, the B creds, needed to go into the hands of more people, and that was the zeitgeist of the day. Seeing that, hearing that, and then deciding to move on to business school. Went back to Boston Harvard Business School. I had a lot of things going on in my head around trying to solve problems in the space and see an opportunity. And it was there where Alex and I met. He was coming from a similar, professional background that he could tell you about, and we just put our heads together. We were both the two oddballs speaking the same language about 1099s and interval funds and such. And after a period of courtship, we decided to do the dance. Alex loves telling the story better than I can, so tell that part.
No, that's pretty much it. I think, from my vantage point, so when I showed up, similar background to Io, right? I was coming from, 4 years in private equity investing, a couple of years at a venture-backed startup. And that landed me in the seat at HBS, and was thinking about the same thing. And, I thought at the time that I had a fairly novel idea when I showed up. And, my second week on campus, people are telling me, hey, you should meet this Io guy. He's doing the same thing. And I think he's like a year ahead of you. So that was, both deflating and exciting at the same time. But lo and behold, we did maybe what you might call a competitive courtship for the better part of a year. And it's really the foundation of the relationship and the trust and the dynamic that we have as a founding team that I think, set us up for success. So the rest is history, as they say, and it's been a happy marriage ever since.
I remember one thing I heard in business school. One of my professors was like, most businesses are run really badly. And that's something I found to be true after graduating, working for various different RAs. And there's a lot of opportunity in the world to run things better, to do things better, for sure. So another thing I'm interested in is you talked about like the pre-AI and post-AI, like building a company pre and post. Is that could you go into a little bit more detail on that? And then a few other questions around like how firms are using AI, what the risks are, how they can use it better, that kind of thing.
Yeah, maybe I'll take the first part and I'll have Io take the second part. So I think for us, that's sort of core to the opportunity in the white space that we saw in the market. right? I think as we were sitting there trying to connect the dots on, okay, what's the opportunity at the intersection of private markets, which is what we knew, and technology, which is where we saw maybe a catalyst or a why now component to the business. And I think while we were sitting in those seats at school and AI was, making kind of a leap forward in its progress, we started to understand that a lot of the challenges that we've seen and observed in the private market space come down to complicated data, disparate data, unstructured, semi-structured, and non-standardized data. And it was a lot of stuff that we started realizing had high potential to be properly solved using newer tech, right? And that may sound obvious, but at the time, I think when we were looking at that, we were maybe a little bit surprised as we examined the market, and we found that there wasn't a whole lot of incumbency in terms of existing solutions, and certainly nothing that was modern by today's standards, right? And that's not a knock on anybody that's in the industry. We have immense respect for the folks that have built their businesses so far in this space and done that quite well with the tools that were available to them at the time when they started building. And I think the opportunity we saw was new tools, new way to build, maybe better client outcomes, and also a more scalable business model for ourselves. So that was the opportunity that we saw as it relates to pre versus post AI era. And to our knowledge, I think we are the first AI native operating system for private markets in our space.
So quick follow-up question for folks that are listening, like structured versus unstructured data, what practically does that look like? And then how does AI weave potentially unstructured data together in a way that couldn't be done before?
Yeah. So unstructured data is data that is displayed inconsistently without any rhyme or reason or schematic to it, right? So what we're doing at Bridge at our core is aggregating documents from different places, uh, taking the relevant pieces of information off of those statements and displaying them to our user in a way that is legible and makes sense and is consistent, and then letting them do what they need to do with it, whether that's push it outside of our system, review it on our system, take action beyond that with that data on our system elsewhere. And so when we talk about unstructured data, as we aggregate those documents and then we look at the information that our user wants from it, Blackstone statements look different than KKR's, than Leonard Green's, than everybody else's, and the footnotes that come off of it are in different places and have different calculations. And yeah, a human can grok all of those things and take that information off with their two hands and structure it into an Excel and make sense of it. And that's how it's been done for a while. But you can imagine how many errors that process introduces, right? Trying to take that unstructured, whether, again, just be the format of the statement, never mind the actual underlying calculations, and make sense of it. And AI is very well equipped to handle that use case. It's, and we say AI like it's new. No, it's been around for a while, but I think the models of the day are even more powerful and, I don't know, more usable, user friendly in a way that you can actually, in natural language terms, tell the system what you want and expect a pretty good output. And so, whether our users do that themselves, whether they use a firm like ours that is building tools in that way, I think the point is like the opportunity is available today to actually use the tools of the day to get better outcomes, to get more accurate data, to save time, right? And I think, it's hard to imagine, and to your earlier question as to like how are firms using AI? Well, we live in the post-trade world. We do what I outlined. Our partners are not necessarily looking to do that, right? They're certainly curious, but they want the outcomes. And so they're working with those folks that can deliver those outcomes with high accuracy in all the ways that I outlined. And thankfully, we've been able to build a business that allows us from day one to use that technology to deliver those outcomes.
So the inputs are like a bunch of different PDFs generally that are all different formats, and then the outputs are what is the output that these firms are seeking?
It's something that is legible, right? And it could be it's in any format that you want. It could be an Excel schematic that has every column that you care about and the numbers in them. And if one PDF doesn't have that number, then it doesn't have that output doesn't have it, right? But it's something that you can perhaps flatten in a way that it is clear what's on the page, as you know, on the output side, and then also like what's not. Another part of this whole story is getting comfort with where the exceptions reside, and focusing your efforts there. So part of what we're doing is providing that clean output, and in a via API, sure, via an Excel download, via whatever our users want, but it's super clear to them what information has been processed, at what confidence that they could trust the outputs, they could see the calculations, they could understand the process that we took to get there, and then also where they should double click and actually spend their time.
Yeah.
I think that's really as valuable as just doing the processing, is telling them where to focus their efforts.
Yeah.
Yeah, it's interesting, Joe. We heard a really great soundbite at a large private equity annual investor meeting recently, where their head of AI was talking about this, and they said AI gets us 80% of the way there in 1% of the time at 0.1% of the cost.
Yeah.
And I think that is directionally kind of right. That's how we think about it. And I think in some sense that leaves you to wonder, okay, well, what's the other 20% then? Right? If it gets you 80% of the way there. And that's why we don't think a lot of firms are actually going to fully in-house, just direct using their own models and agents to build stuff, because in some use cases, sure, it can probably get you 98, 99% of the way there. For this use case and a space where the accuracy of the data and the nuance of the data is very important, you have to overlay a whole ton of business logic, workflow automation, task management, and exception handling with what the AI is doing. And that's really at the core of what we built is, an AI native system, which has a ton of advantages, but you can't just set it and forget it.
Right.
Right. And that's a really key component to understanding why I think application layer businesses in our vertical will need to continue existing in a real way.
Yeah. No, I'm getting that over and over. Like a lot of people are joking, like you can code up a CRM in a weekend or something using Claude Code or something. But there's so much that goes into a CRM, especially a CRM for financial advisors, maybe especially for family offices with different needs, different data, different goals with it. And I think that's where tools like Bridge can offer specialized AI to get the output that they're seeking. What
Yeah.
are some of the risks that you're seeing as firms try to implement AI?
Yeah, I think the main risk is it's really lies in the assumption that we were just talking about, right? It would be firms trying to employ AI and assuming that it's going to be right,
Sure.
right? Assuming that it's going to be accurate without much work on their end. Um, and, I think especially when it comes to things where there are deterministic answers, right, to questions and problems, and what number was the right number? Well, that oftentimes is a direct deterministic thing, right? And AI inherently is a probabilistic based system. And so I think that's where you see a disconnect often, right? Is trying to rely on it for answers that may not be the same twice in a row when that data point, in fact, is the same every time. Right. And so I think lack of the appropriate guardrails, lack of the appropriate oversight, and maybe an overinflated expectation or assumption around what it can and should be able to do by itself is maybe the three areas where I see the biggest risk, at least for firms that are trying to directly use those tools in-house.
Yeah. So, like, if you ask it 2 plus 2, you might sometimes get 4. You might sometimes get 5 or 6. That is that kind of what you're
I
inferring?
there was a time where it was like the joke was it couldn't figure out how many R's were in strawberry, right? Like that
Right.
was, I remember back probably, I don't know, a year ago. I think to give those folks some credit, they've come a long way and it's a lot smarter now with quantitative figures than it was then. But it's still, right, that whole 80% of the way there, we really do see that and believe that's true. Like if we just let AI do all of our work at Bridge, right, we don't sell AI. AI isn't our solution. Our solution is you not having to do this work manually anymore, right? That we're selling a business outcome. AI is one of the large components and inputs to how we get there. But if we just let AI do everything, our solution, we'd have 100% churn in our customer base as opposed to 0% churn, which is what we have today.
Yeah. Are you able to price differently than your competitors because AI maybe is doing more of the work that they're doing manually?
So we can or we could, but what I would say is so far, uh, price has been less of the area of focus
Okay.
for us and for our users, right? I think
Sure.
right now the cost of failure for the user is very high, and so the sensitivity is less to price and it's really to quality. It's, can you actually implement this to 100% for me? Can I actually rely on your system because I know that you're not just using AI, but that you have a robust apparatus around your AI that makes me trust that the numbers that my client sees at the end of the day are right, and that I don't have to be the one checking it. And maybe you're telling me here's the edge case 5% that you do need to check.
Yeah.
Right? That's what we're selling, and that's what folks are sensitive to, right? Because if you think about the types of folks that we work with, wealth management firms, single and multifamily offices, institutional advisory, businesses, OCIOs. For them, having data be incorrect is the death knell of their business relationship with their customer.
Sure.
So if that's what they're relying on us for, that's the implicit promise that we've made, and we need to show up and deliver on that, right? So that's, I think, where folks are sensitive, not as much on price.
Yeah, I also add away from price on just the general AI topic. I think Alex, a lot of your points on where the risks are, how should you use it are good ones, and they maybe speak to like evaluation after the fact, right? How can you tell that 2 plus 2 equals 4 and not 5? AI is super confident, and so you definitely need to have a good evaluation criteria for whatever model you're using to understand that what is actually right and what's wrong. But I think on the like upstream of that, um, it's garbage in, garbage out, and AI doesn't necessarily solve bad data, right? It amplifies bad data, and yes, you need to be able to evaluate on the back end, which is maybe again different, but we try to understand our inputs very, very well and try to take them from the primary source as much as we can. Um, because that's, and it's a never ending quest to like get straight to the source so that you can trust that data that's going in as much as you possibly can. Um, but I think when we talk to folks, it's like, yeah, let us all try to think about it that way, which is plug us into the right place. Let us not necessarily see like the after or like the v2. No, let us get to the primary source such that our model can then do its thing, and then of course we have the right apparatus in place to evaluate how effective it was. But if we're getting bad stuff on the way in, it's no one's gonna be happy.
Have you ever thought about like going one level up into the firms actually producing these documents? So, like, is there a way to standardize the documents coming out of all the different private investment firms?
Joe, that's the holy grail, right?
Yeah.
And if you know the powers that be that will allow us to solve that, we would love to. Because yeah, we're all everyone knows that this is that the GPs or the other members of the ecosystem that are upstream of us have a lot of the power here, and as two guys who are making these reports, like, um, you got to have the incentive in place to solve this for the other side. And I think it's an interesting time for that conversation to be had, right? As these products are really now flowing into the hands of a broader universe, right? Talking about getting alts into 401ks. That trend is going to require a lot more standardization in the data if you want everyday doctors and doctors and dentists are already getting it. Beyond the doctors and dentists getting their hands on these types of products, well, maybe that's what's going to be the kick to try and standardize this stuff as much as it can be. And I think if and when that does happen, that we'll love to plug right in and be a help. But yeah, trying to get to that source is something that we're all trying to aspire to. And I think at the same time, AI and some of the tools we're using a lot, maybe lessen the need for that because we can, more robustly handle the ambiguity. Um, but yeah, we'd always love to talk.
It's an interesting question, Joe, because it just building on some IO's thoughts there, right? If you think about the thread that it's really pulling on definitionally, what does it mean to be a public market or private market investment, right? Like,
Sure.
what really draws the line there? Right now, today, it's some combination of access, liquidity, and transparency, right? Public markets, there's a marketplace to go and buy and sell them at any time. The data is relatively standardized and regulated in terms of what do firms have to put out and on what cadence do they have to put it out. When there's a big change in a major key decision or personnel or all sorts of things that mandate required documentation in a standardized format on a cadence, right? And that's everything that does not live in private. And as privates become more public, so to speak, okay, well, where are we seeing that happen? Access first and foremost, right? 401ks, 1099 interval funds, semi-liquid products. We're seeing access become more public and more democratized, right? Just to use the word that everybody uses. Transparency, not sure if and when that's going to happen, right? And because to Io's point around incentives, like as a private manager, one benefit you've had for the entire existence of this industry asset class for about 50-ish years or so is the fact that you sort of get to avoid the market volatility in publics. And everybody kind of knows it's BS when you put out your marks at the end of the quarter and there was some crazy macro event and like you held everything flat to last quarter. It's like, really? Like, what about, public SaaS companies are down 20% and your enterprise SaaS portfolio is flat to last quarter? But hey, who's going to tell them they can't do it? Right. Sure. And so, it does sort of get, and then liquidity being the last one. And, early days there, right? We have a lot of ambitions around secondaries and how we think Bridge can play a role there in the future using our data. But, I think that's still in its early days as it relates to facilitating more liquidity, whether primary through, interval funds or secondary through more direct, peer-to-peer transaction capability. And so our bet is that that may happen one day on the transparency and standardization side, but it's a day that's far away. And until that day comes, it's a core problem that we're trying to solve is creating that standardization out of the chaos.
Yeah, no, it's almost the gap that you guys are solving in a way. Like if it was all standardized, you
Right.
wouldn't have all this dirty unstructured data coming in and you're putting out structured data. So like the whole market as a whole, what is the size of like private investments versus public investments? And then as a follow-up question to that, like what size RIAs or family offices are starting to introduce private investments to their clients, as they move up the net worth range?
Yeah. So, the alts market today, various people will have different views on this, but most people would align on it being around 25-ish trillion dollars in assets, something in that zip code. And most people think that it's heading in the next decade to call it 55 to 60 trillion dollars in assets, right? And so the big trend is that private market asset classes are gaining AUM share relative to public,
Okay.
right? And you're seeing that in all sorts of ways, right? You're seeing companies that are staying private really long and getting to really, really high enterprise values before they ever reach the public markets, if they ever reach the public markets, right? And so when you see companies like, Stripe, pushing $100 billion valuations at one point, right, as a private company, and SpaceX, and right, all sorts of examples that you see out there, I think it's spurring a lot of the demand and a lot of the focus on the access piece and the quote democratization piece of privates, because the idea of, oh yeah, once a company gets to a certain point, it goes public, right? Maybe 30, 40 years ago, that was the paradigm. And so then the public could participate in meaningful equity growth and compounding of those businesses as they went from, being a $500 million or $1 billion valued company to being a 5, 10, 15, $20 billion valued company. Sure. Right? Today, if Stripe finally goes public at $100 billion valuation, okay, well, you're starting your attachment point to participating in the equity growth of that business from a pretty late stage. And so I think that's one of the inherent things that's driving that trend. And, we could unpack why that even happened, right? But I think private capital was enjoying excess returns, classic supply demand, more entrants into the market, a lot of capital looking for a home. And so now you've ended up with, frankly, kind of an oversaturation of private capital funds, many of which may not continue to exist in the next cycle, candidly, right? Because I think the pressure on returns is getting real. Price to perfection is getting real. The early days of that industry was the Wild West. I mean, 90-10 leverage, very few buyers to compete with, and returns were nuts. And that's kind of how it became what it did. So that's the trend I think that we're seeing there. On the second question around RIAs, family offices, I guess when they start to participate, I think, again, maybe tying into that previous comment, it's sort of a moving target that continues to shift down market, right? Because I think typically you'll see folks dip their toe in the water with a, interval liquid, semi-liquid product, right? Okay, hey, this can show up on your 1099 just like your other trades, and you can get out every quarter. Redemption gating be damned. We'll talk about that as well if you want to. But in theory, right, get out when you want to, and be able to participate with low tickets, right? And so I think that's really opened up not only the addressable market for alts, but also the stage and size of client profile that gets offered alts. And so today, what we see is that even if you're a smaller RIA or you're an RIA with a more middle of the road net worth client base, increasingly you're asking yourself the question, do I need to have alts in my offering to be competitive? And increasingly the answer to that question is yes. Right. And so I think that a lot of people are focused on that. And then the next logical question becomes, do I have the right systems and team and tech stack in place to actually effectively both deliver pre-trade alts, but also then to manage those alts products and scale them? Yeah. Right. And so that's, especially as it relates to our segment of the market, that's the conversation that we see and hear and have a lot.
It's interesting. I posted about this on LinkedIn, and an advisor with, I don't know, sub 100 million under management was like, oh, I'm starting to look into private investments for my clients. Where would he go to start helping his clients get into private investments, and then reporting on the returns and stuff?
Yeah, I mean, he would probably, I guess I'll rattle off some friends in the industry. I mean, he could certainly be looking at solutions like iCapital and Case, which, were the first movers on the pre-trade side and have built, really impressive businesses there. There's maybe a newer crop of folks that we're friendly with who are making waves in that space as well, whether it be an Opto or Glass Funds, or, we've got plenty of folks that we've brushed elbows with, over the course of the past few years as we've been building Bridge, who have, built more infrastructure opportunities to facilitate trade, right? Pre-trade and the point of transaction, to make that subscription process a little easier. Got some friends over at Subscribe. They've built a really neat solution for automating that subscription process as well, right? So there's a host of players that have tackled those pre-trade workflows to try to facilitate, the discovery, due diligence, and transaction subscription process into funds. And I think that's probably the natural starting point for those types of folks.
Okay, that makes sense. I honestly don't know a lot about this space. But do you like VC, growth equity, and private equity fall into the private investments category generally?
They do. They do. VC, PE, like buyouts, growth equity, real estate, private credit, um, real assets, infrastructure. You can think of anything that isn't stocks and bonds, and I mean even crypto is a private investment, not necessarily the space where we play, but um, hedge funds also considered a private investment. Just your non your K1 generating assets. It's one way to think about it.
Sure. I saw a podcast with Tony Robbins and Peter Maluk, and Tony was talking about his private investments, and I don't know. He said he was averaging like 17% compared to the stock market, which averages, I don't know, 10 to 12% or something. Dave Ramsey would say 12. Everyone else would say like 8 to 10, maybe. Is that one of the biggest draws to private investments? Is the potential for higher returns, or is a lot of it simply just the diversification of investments?
Both. I think the Alex already spoke to the crop of companies that are now staying private for longer, and so just that fact means that private investments are you cannot ignore it, right? All of the alpha is being generated in private, and then by the time a company goes public, good luck. So it's both diversification and they are historically higher yielding, if less liquid, obviously, than your S&P index.
Yeah.
Yeah, and Joe, I mean, right, what the contrarian would say is they would say, well, if you look at Mag 7 returns and then you compare it to like average benchmarks across private asset classes, especially adjusted for liquidity, there are many who might argue that, oh, actually, it's not true, right? And I think that central to that is just speaking to how much differentiation there is now amongst managers in the private asset classes, where before I think you could generalize a lot. Oh yeah, PE returns X, private credit returns Y, venture returns Z. Earlier in the asset classes life cycles, and I think today there's now a very rigorous assessment of managers within each of those buckets that is critical and central to the alt allocation business, because it is now very much the case that within those buckets you can't generalize so much. You really are, if he's earning 17%, that probably means he's done a pretty good job either having the right access or good evaluation, and bets on good managers.
Sure.
Right. And so you certainly can outperform meaningfully in the private markets, but you can also underperform. And then once you take liquidity and, friction into consideration and you adjust quantitatively for however you weight those things, certainly there are cases to be made that it's not always true. So I think that that's one of the big risks that I think folks have always assigned to allowing broader participation to privates, because there's a perception that private private markets is the rich investors game, and by being left out of that, you're missing out on the opportunity. It's true, but it's more nuanced than that.
Yeah.
Right. And so I think that's where there's been a lot of fear around, okay, if you just open this up to a bunch of folks who have their entire life savings sitting in that 401k, and all of a sudden it has 30% allocated to semi or illiquid private funds, many of which fall into the bottom, quartile, for example, of that asset class, they might be in trouble.
Yeah, no, it sounds a little bit like bank on yourself, the purchasing whole life insurance, and then taking loans against it, basically. It was called like invest like the Rockefellers and stuff. But that it does work incredibly well for some people, but it is much more nuanced than to take that concept and apply it to, your average American. Yeah, I'd love to talk more about the redemptions. Josh Brown made a joke about it. I can't remember exactly what he posted, but something about gating redemptions a few weeks ago. So what is the access problem or not access, but like the liquidity problem with private investments?
Sure.
Yeah, I mean, I'll take my first very, very short crack at that, but I would say, in some sense, right? It's sort of like the classic run on the bank sort of it, right? It's like, yeah, no, everything's good and safe at the bank, and we have your money, and you can come get it at any time, unless all of you come at the same time asking for your money, and then we're up shit's creek, right? Like that. That's sort of the same, I'd say, conceptual analogy to it, which is this idea of making redemptions available, and that being a major selling point intrinsic to that product, but having that be challenging if an overarching critical mass of investors all wants to redeem at the same time, which is not what they underwrite in their models, right? So like that's kind of the central issue there. And then I guess the discourse around that being, well, should that be allowed or not? Right? Should they be allowed to hold back what they sold as true? Right now, of course, somewhere in the fine print on page 112, it said, if that number in aggregate exceeds X percentage, 5%, right, then they have the right to gate that off. But at least, anyway, that's my take on what's going on there. I'm curious.
Yeah, I think I have much more to add. I mean, there's it a lot of it boils down to expectation management, right? If you go to the docs to that footnote on page 112, that's not what you really want to do, and even if you can, it's not what people expected. And having not been super close to any of that stuff and just following it from afar, can somewhat appreciate how difficult it is to manage liquidity for these vehicles. There's a lot of stuff that goes on beneath the hood that, like, we don't know that much about, but I can say it's definitely tricky. And assuming best intentions, yeah, it just a strategic shift like that it was not like forecasted to the market and was not handled delicately is really where I think the biggest fault is there. I think people would understand if you were explaining the rationale behind, because they ultimately did like give a huge quantum of dollars back. It was just the way that it went about, which was not handled with the right level of care. And yeah, it's just a cautionary tale on like expectation management. I imagine this stuff happens all the time in the institutional channel, but when you're dealing with this, wealth segment, a lot more people, a lot more voices, a lot more regulatory scrutiny, and thus, you can't handle situations like these like you would when you could just pick up the phone and call, one large institutional counterpart.
So maybe individually, what are you guys excited about the future in private investing? Like it seems like a smaller topic that both of you, found each other at Harvard and then, decided to start something together. Not something maybe a bunch of your peers were talking about, but what got you guys excited about it? And then what are you excited about in the future?
I think there's building a business with a friend and a culture, with friends, and then there's the specific domain that we're playing. And I think on the business side, like, yeah, this has been a really fun ride so far for us, to go from bonding over this esoteric space before we even knew each other's last name to joining forces, and then spending a good amount of time just like walking through the desert blindly trying to find a problem worth solving, and then a problem that people would really pay for to have solved, and to fast forward to where we are now, and what is not that much time has passed, but to be really servicing customers, to really be building a culture, really just kind of owning your own destiny in a way that is fulfilling, enriching, and um, couldn't imagine spending my time anywhere else or with anyone else. And yeah, the domain, I think Coming from Blackstone and having seen this stuff just in my face for so long, I certainly understood where the opportunity resided, what the trends were pointing towards. I do believe that more folks should have access to these types of investments with the right level of infrastructure and with the right level of transparency. Then there's no reason why someone shouldn't have the free will to invest how they like. And you're starting to see some of that take shape again. Regulatory changes around accreditation standards and 401k and other. So I think that for me, it was a combination of having the domain expertise, also fundamentally feeling like this should exist, and then trying to find what part of this was the bottleneck for it existing, seeing access really be mostly solved, seeing opportunity on the post-trade standardization, seeing new technology that can actually make that solvable in a different way from others, and then doing so with friends. It's been a joy.
Yeah, no, that's great, Alex.
That was well said. It's gonna be hard to add much there. I mean, maybe the only additional thing that I would put out there is I think timing is such a critical component of life in so many ways. You know, right person, wrong time, right idea, wrong time, right? You see that all the time in life, right? Across business and otherwise. And I think that it's very rare to have the timing of everything line up in a way where, for many reasons on the macro driver side, the timing was right for this opportunity. And it also just happened that it was at a time when, two of us independently were maybe taking a step back from that more traditional path of just rising and, going up the corporate ladder in the PE world and saying, is that what I want to do? Is there something else that might be out there for me? And to have an entrepreneurial opportunity align with the macro timing, align with the timing of, the right person to do it with also wanting to do it, and being in the position to actually spend the time, establishing the conviction around that idea to ultimately go after it. I think that played a big role for us. And then to also have the area where you see the opportunity be fairly well aligned with the actual domain expertise and maybe the right to win or the right to even tackle that opportunity. Right. So I think it takes so many of those things to align for it to make sense. And when they do, you kind of have to take that head on and run with it.
Yeah. No, I think Jim Collins calls it like return on luck. And I think Malcolm Gladwell has written about it too. Like, what are the chances that Bill Gates got to be in that high school that happened to have a computer that he happened to have the time to spend like so much time on it? Was born in a specific month where something happened. Like, it is pretty cool to see all these factors come together at the right time. That's pretty neat. All right. Well, speaking of time, we're up on the hour. If someone's interested in finding out more about what you all do, where should they go?
Yeah, they can head to our website, which is bridgeinvest.io, or they can email us directly, alex@bridgeinvest.io, io@bridgeinvest.io.
All right.
And
Perfect.
Alex's phone number is.
You know what? That's fine. We can throw my phone number out there too. Why not?
I'm just kidding. No, Joe, this has been great. Thank you very much for having us.
Yeah, you're welcome. Thanks for coming on, guys.
Thanks, Joe. Enjoyed the
All right.
chat.
Take
Talk
care.
later.
Appreciate it.